Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, I'm thrilled to be joined by Chief Economist Don Rissmiller to talk through inflation and some other items affecting our economy. Don, how are you doing this morning?
Very good. Good to talk with you.
Yeah, thanks for being with us, and timely as we're recording on a Thursday, one day after getting the hottest CPI print, the hottest inflation print in 40 years. So I just want to turn it over to you. What's your big takeaway from this? It seemed maybe kind of in line with expectations, but there's a lot to parse. So what are you looking at? What are you thinking about from this report?
Yeah, so it's an important report to end the year. It was a little above expectations, but the expectations are now coming with such a wide range around the estimate that I think it was within bounds of that. So I think it's reflecting the same dynamics that have been happening all year. There was this idea that bottlenecks would clear, but as we've had additional virus variants, and this was the Delta variant and the Omicron variant, we have affected the supply side of the economy consistently throughout 2021 into 2022. And so there are a number of different bottlenecks that we could list for: product, transportation, labor, and energy. And we were starting to make some progress on the bottlenecks, at least on product and transportation, as we got through the end of 2021. But that's getting a little less certain as we look abroad, look at what's happening in China just this week. Do we have additional interruptions at ports? Do we have additional interruptions in the supply chain? So we're not through that story yet. We were making some progress, but time is really the answer there. I mean, at some point, if the economy gets past some of the health concerns, bottlenecks should clear, product should show up. But that's really what we see in the core goods part of the inflation metric. Core goods very rarely inflate much at all. And over the last year, they've spiked higher. So that's what's out of bounds. And that's the best argument that this will return to earth, that you'll get some mean reversion, that the transitory argument really revolves around that core goods piece starting to behave like it's behaved for the last several decades, which is there's not a lot of inflation that usually comes out of that sector. The problem is really it's been elevated for so long that it's starting to creep into other stickier components. So wages, rents, expectations, we're getting a little bit of movement there. And so the labor bottleneck, which is excess retirements, is any interruption in the pieces of the economy fitting together. So we still have the education sector not functioning as it did. And so that interrupts the ability to supply labor in some cases. There may be good reasons for these policies, but there are consequences and effects of this as well. So if we keep watching these bottlenecks, product, transportation, labor, energy, I think we'll get a good handle on the inflation story. But we need to see a peak bottleneck story that'll lead to the peak inflation story. And we may be getting there, but we're not there yet.
Right. Yeah, not there yet. And then that brings into question the timing of everything. So the Federal Reserve has turned noticeably more hawkish. They're pulling rate hikes forward. But as you mentioned, a lot of the inflation problems are on the supply side. So how does the Fed thread the needle where they hike rates, try to reduce demand a little bit, but knowing that it's a supply side issue without, breaking demand so much that we send ourselves into a recession? It seems like a very thin landing strip for the Fed to hit.
It's hard for sure. The reason I think it's possible over this year is the Fed should get some help. In other words, they're not going to have to do this by themselves. If we were relying on the Fed alone to bring inflation down, then I think that's right. This would be a very, very hard landing to execute. But what we're saying is the Fed should adjust policy. We've seen some move in inflation expectation. We've seen some move in wage measures like the employment cost index. So the Fed, which was focused on employment, focused on easing, needs to switch. But do they need to switch so aggressively that they cause a recession? And I don't think that's necessary if we get a couple things. So first of all, goods inflation should moderate, like we talked about, if bottlenecks clear. Services inflation needs labor supply to show up, and there is the potential for some productivity improvement to help offset the components like rents that are now starting to move. So the path to a soft landing in the economy is a path to a mid-cycle slowdown instead of a recession. involves moderate tightening and involves the private sector helping the Fed at getting inflation down to a more tolerable number. But inflation is the key in 2022.
Absolutely. Well, let's end on a positive. So that productivity piece, we've talked about it before. It's been a bit mixed, but I think we're starting to see some pretty clear evidence that some of the efficiency gains from the pandemic will be sticky, and to your point, can offset some of those other headwinds. Are you continuing to see that, and what's your outlook for that going forward?
Yeah, it's a very interesting piece of the puzzle because we've had trouble for the past decade getting productivity improvements, especially in services. But if there is some silver lining to this type of shock, it's that we're forced to do more with less. And so what we've had is we've had too much money chasing too few goods. We've had inflation for the past year. The pathway now is to get the same amount of money. So let's stop QE, let's change policy, and then let's get more goods. And that's the other way to remove this pressure. And I do think it's not a terribly hard story to tell that we could see, especially in some of the higher value added services, telehealth, doing finance remotely, locating tech workers in cheaper cities, anything that can bring the cost of business down and keep it down can help on this side of the puzzle. And so productivity is notoriously choppy, but if we ended the year on a decent note for GDP, we should have been ending the year on a decent note for productivity as well. And I think that will show up in the upcoming data.
All right, well, Don, that's a lot to parse and some great things to keep an eye on. We really appreciate your expertise and your time, and stay safe and have a great rest of your afternoon.
Thanks, Ross.